So yeah, let's use this panel to discuss a little bit how we could set up structured products around BTC. Just a little bit of heads up. This is a short notice panel, so we are kind of changing this format a little bit, making it more into a discussion because it resulted out of basically the idea of launching a joint product around BTC that is enabling sustainable yield. And yeah, we just thought about bringing the whole product discussion on stage, which is kind of an interesting format. And that is the idea behind this panel now. Maybe let's start with some intros first, though. So yeah, Mirko, why don't you kick it off?
Hi, my name is Mirko. I'm CEO and co-founder at Stake Rewards. And yeah, we just launched a liquid looping token on Hyperliquid, and we are also looking to expanding this to BTC. And that's why we are kind of working with partners like Lombard and Plume to create a really interesting structured product that hopefully can unlock billions in BTC stake, basically. Yeah?
Hey everyone, my name is Maksym. I'm a DeFi lead at Lombard. At Lombard, we're building a full stack Bitcoin liquidity and yield layer. So initially we launched with this product called LBTC. It's our flagship liquid stake Bitcoin. The underlying Bitcoin goes into Babylon to secure Bitcoin secured networks. And down the line, we were exploring many different ways to expand the stack. We ended up with building our own decentralized custody. We have over 15 consortium members in our security consortium securing Bitcoin. There are many leading players from mining, market making, leading distributors like exchanges, etc., to really trust minimize the process of custody. And then when we figured out that, we realized that distribution is also very important, and we found ourselves in a very fortunate position where we managed to distribute pretty well. We have more than 70,000 users today using many different sorts of products built on top of LBTC. Those are countless DeFi integrations, well-known ones like Aave, Pando, etc. And those automated products like Vaults. We have a couple of products where you basically just have this one-click deposit, and the funds are managed across DeFi in a relatively conservative fashion to generate yield fully automatically. So yeah, we really want to cover the entire stack, starting from the underlying security of the native BTC and leading up to the distribution and owning the end customer.
Hey guys, I'm Jack. I lead ecosystem growth at Plume Network, which is a layer 1 blockchain purpose-built for RWAs. So we handle the tokenization of those assets, meaning the legal and administrative and technological infrastructure for bringing new assets on chain. We make it really easy for people to bring new assets on chain, be it boring stuff like stocks, corporate bonds, municipal bonds, T-bills, whatever, and then all the way up to more exciting, weird stuff like esoteric assets like durian farms and camel ranches and Pokemon cards and pretty much anything you can imagine, anything in between commodities. So like if it exists in the off-chain world, we're bringing it on-chain. Yeah, and so we also create a full DeFi ecosystem around these assets. So we've got about 200 protocols currently deploying on Plume. A lot of asset issuers, obviously. Full suite of DeFi toolkits to use and make these assets a lot more productive, right? So taking a yield token for solar energy, being able to use that as collateral and borrow some kind of private credit against that, and then using that as collateral to purchase tokenized equity in a durian farm or something like that. So yeah.
All right, perfect. Yeah, then let's jump in. So with Bitcoin, I would say it's the hardest and most market capitalized assets right now in the space. And for a long time, it was just like an asset that is sitting around. People are hodling Bitcoin, but the markets are also maturing. And now there are actually yield opportunities that are building on top of BTC. So maybe to start off the panel, let's investigate the problem space right now. So what would you say is still missing in this maturing space right now in the current staking, with the current staking solutions that are available on the market?
Yeah. I'll go first. Yeah, look, I mean, I think it's the same issue that you're going to get, the same answer you're going to get from me about anything in crypto. It's that so much of the value in crypto is locked up in these recursive markets where everything is very insular, and it needs to be able to interact with other things, right? So right now, the highest yields you can get on Bitcoin are fairly low, despite it being a very liquid asset, right? On-chain yields for Bitcoin are typically between like 0.5% or even less than that, up to like maybe 4%, right? So we need to find ways to unlock the liquidity within Bitcoin, because there's obviously like many billions of dollars that are currently locked in Bitcoin. People want to be able to earn a yield on that. Right now, it's just like the buy and hodl asset that people are going to hold for the entirety of their lives. A lot of people have so much of it at this point that they just don't want to sell, because they don't want to have to pay taxes on the amount that they're selling, or they want to keep their directional exposure because they're continuously like bullish on Bitcoin, or like for especially for like Bitcoin miners, right? They want to be able to unlock the liquidity while keeping their delta exposure to Bitcoin. So finding ways to connect that Bitcoin liquidity to the real world, make it accessible, and earn yields on it through ways that are not just intrinsically DeFi related yields.
Yeah, to me, there are definitely many ways to generate yield. It's not necessarily specific to Bitcoin. It just happens to be that BTC is an exceptional collateral, yeah, but not really a great asset to deploy like actively, because people don't want to give it up, to give up the exposure. It's the most biased asset in everyone's portfolio, and again, it's just a matter of unlocking the utility of it without actually giving up the underlying. And there are many different ways to do that. Wrapped assets and LSTs is one take on it. It's really just the starting point, and then I don't think that staking yield should be something that people should necessarily hyper focus on. It's not meant to be extremely high. It's like Ethereum is generating what, 3% per year with its native staking, and this is the most risk-free solution we have today. We do believe that Babylon and staking with Babylon is probably this closest thing to native staking with Ethereum for the risk-free rate, to get this risk-free rate for Bitcoin. But then it can't be really like, huge, obviously. That's sort of the trade-off you get for extremely risk-averse type of deployment. But then you can find many interesting ways to deploy it further down the line, and those are different sorts of DeFi integrations. Like Pendle, for example, is doing a good job with tokenizing yields at specific maturities. That's interesting. It allows people to speculate on yield down the line. What is also nice is every ecosystem is craving for new liquidity, and again, Bitcoin happens to be the cheapest source of liquidity. It's way cheaper than stablecoins, obviously, but it's even cheaper than Ethereum. So we have many ecosystems running their bootstrapping campaigns solely dedicated to Bitcoin, or even if it's not solely dedicated to Bitcoin, it happens to be that Bitcoin takes the dominant share. Like, this is what happened to Berachain recently with their Boyko campaign, where from the $3 billion of TVL they acquired, roughly like close to 2 billion was actually denominated in BTC. Berachain is probably the largest Bitcoin L2 today, if you define it by the underlying asset. So that is a great source of yield. Ecosystems are willing to pay a lot for that. And then we have the TradFi side of thing, off-chain strategies which are close to not possible to execute in DeFi today. Different sorts of derivative trades, like basis trading, etc. There are teams who are doing this today on decentralized rails, but it's really difficult to scale it yet. And Bitcoin requires a lot of capacity for scaling. So tapping into that, into those off-chain strategies, tokenizing them, and providing people with the representative on-chain that they can use to maybe leverage it or use it as collateral to borrow stables and do different sorts of manipulations with their portfolio without giving up the Bitcoin, that would be a great use case.
Okay, yeah, real quick, I'll give the mic to you in a second, just real quick, summarizing, so you don't want to lose basically exposure to BTC, that was one major takeaway. Also, security is a big topic, and also tapping into some other opportunities on the structured side is something quite important. Maybe since we have the opportunity to have like some of the biggest BTC distributors for yield generating products here on stage, if you were, hypothetically speaking, launching like a product that is generating sustainable yield in this huge market that is still heavily untapped, how could that look like? Maybe on a high level, Mirko, you can explain a potential vision here, and then we can go in depth how each ecosystem player here can contribute in this product.
Awesome. Yeah. So I think obviously there's a lot of BTC already on in the DeFi space for like very low yield, and yeah, that's a huge opportunity. And kind of creating a product that really creates more sustainable yield. You cannot imagine how much BTC that's going to unlock. I think the demand for BTC is like insane actually, and like it's really, really big. We already see it for very low yield. What is there right now? So if there's a way to create a product, like a structured product, and that's I think what the structured part is about, trying to unlock like different yield sources, and also like the concept of staking is evolving, right? It has always been thought about staking as just economic security, but there are other staking use cases that are coming up now. Like you can use staking as a way for like economic collaboration, securing things, insuring things, and so on. And these are all sources of yield. And then it's about creating a product that really unlocks the yield from other sources and funnel that into a single product in the most efficient way. And I think that just creates a huge opportunity working together with huge partners that have the capability to do that. So I think this is probably a great way, maybe also for you, Jack, to unpack like how can like RWA yields be funneled into an on-chain product in the end.
Yeah, 100%. So look, I think this is something that you have to be cautious on, right? Because obviously Bitcoin can be very volatile, but there's, the yields that you need to offer don't need to be that high for people to get very interested, right? Like, Maksym mentioned the Berachain Boyko campaign where they had like $3 billion worth of liquidity coming in. And if you actually look at the underlying assets, like he mentioned, most of that was just Bitcoin and Ethereum. And the rates were like 4.5% with like 30 to 90 day lockups, right? So like, why was it so successful if the yields are so low relative to the rest of DeFi? First, like DeFi has really kind of warped our views on what like good yields are. Like in TradFi, getting a 4 to 6% yield is fantastic, right? Getting anywhere north of that is amazing. And if you're working with $100 million because you're a big whale, like even just like 1 or 2 extra % goes a long way, right? Like 1% of additional yield on $100 million is another $1 million, right, for like per year. So you know the LTVs can still be fairly low, right? Like you can still manage you can still be very careful about like liquidity thresholds. And I think ideally it's best to also, because you know these people who want to unlock the yield in their Bitcoin, they don't want to risk their Bitcoin because they're very bullish on it. They want to maintain their directional exposure. So like they want products they're not going to get liquidated on, right? So one thing that we're working on, and you know, I think we'll get into how this factors in with Lombard, you know, shortly. I'll let Maksym, you know, dig more into that, right? But like we have this Nest product that we've incubated in house at Plume, and it's like a yield vault product, and we've got you know several different products for this right now. We've got some T-bills products, we've got some. You know, we've got like an NRWA product that has like various private credit and corporate bonds and a bunch of other stuff in it. And one of the things that we're doing with this is we're also doing NBTC, right? And so that's on the roadmap. It's not going to launch with day one of Nest, but it's coming very soon. And NBTC, the way that it works is basically we have this partner called Winfell, and users can deposit several types of like highly liquid wrapped forms of Bitcoin, be it like WBTC native, it could be native BTC too, it could be like, you know, WBTC, CBBTC, whatever, right? You deposit into the vault, you get your receipt token, which is NBTC. Then what happens in the underlying vault is we give that Bitcoin to it's custody. So we give that Bitcoin to a partner called Winfell, using Hidden Road as a prime broker, right? And then they borrow against it at like a 60% LTV, and they do a CME basis trade on it, right? So they keep a very, very low risk strategy. They're yielding like 6 to 8% returns, which is crazy for Bitcoin, right? It's like twice what you'd be able to get. And then when you incorporate that into like additional flows with stuff like Bitcoin staking and like LBTC, you can juice some like really potent yields off of this currently exceptionally latent and like underproductive liquidity. But yeah, so I guess I'll hand it off to Maksym to kind of like dig into however much he wants to go in there.
So from the new source of products and yield opportunities, well, to begin with, obviously, off-chain side will be very important to be able to successfully tokenize off-chain strategies with sufficient risk management in place on the off-chain side again, because this stuff is just really difficult to verify and make it on-chain available. That is a whole big task on its own, and you guys are working with this every day, and this is something that Lombard is also exploring. You definitely need strong partners on the TradFi side with all the necessary licenses in place and significant track record. And what is most important, you need to convince them that you know, this thing that we call Bitcoin DeFi today, which is probably well, if you count like the last cycle, WBTC TVL is like what, $10 billion at best of size, is worth to make a bet on, is worth to partner and explore those opportunities that someday it will actually bring tens of billions of dollars of inflow into those strategies, and those people will be able to make money from it. So yeah, off-chain side is important. Basis trade is, well, as Athena taught us famously, is a big elephant in the room. It's a great strategy. It's very sustainable. It's definitely multi-cycle, and this is something we will also focus a lot this year to figure out the strategies that are truly multi-cycle. What else could be there? I think Bitcoin trading could potentially provide good source of yield on chain. We already see fairly decent volumes for like WBTC and CBBTC on like Ethereum and Solana, but this is really not, this is like peanuts of what is actually generated volume-wise on centralized exchanges for Bitcoin. Bitcoin has way more, consistently way more than 50% of global crypto trading volume, yet on chain its portion is like close to 1%. This is something that leading DEXs are already working on, and we are supporting them with to provide access to the Bitcoin in their liquidity pools. There are many good examples of new models which are very efficient, like Fluid DEX V2 or Yield Basis protocol, which is built by Michael from Curve. Those products have a potential to generate hundreds of billions in volumes and generate very good fees. And be sure, like, DEXs definitely make very good fees from this, and there is no reason why liquidity providers on chain cannot tap into that as well. So yeah, I really see those two as major unlocks coming this year. And maybe lastly, it's very important to stay proactive. Again, talk to the new ecosystems. They are very hungry for liquidity. The pie hasn't been really growing. The liquidity pie, the total TVL in DeFi hasn't been really growing this cycle. And the reason is because, well, there is a finite amount of money that is being redistributed across ecosystems, and Bitcoin is probably the only asset that is able to provide net new liquidity to the game. And all the ecosystems will be super hungry and will be willing to pay very good incentives, which is yield for users. Maybe it's not extremely sustainable, but if you're proactive enough, and this is what we really want to do, to be proactive enough to cater those new fresh ecosystems that are willing to pay good incentives and allow our users to benefit from it.
Yeah, so maybe let's tap into the opportunity a little bit more. So, for example, on Ethereum, because like people really don't want to lose exposure to BTC, we also see a lot of Rep BTC right now lying around on lending borrowing protocols on Ethereum, right? So the APYs of borrowing BTC right now is also super low. So I would say that is also a great opportunity to build products around that. So maybe let's discuss how we can basically leverage this opportunity. Yeah. To build something. Yeah.
I think there's like probably 4 billion or something in Rep BTC and Aave right now. There's like, which you can borrow at like 0 point something, but it's very low. So obviously, yeah, this is like this Bitcoin that is on chain and is not demanding a lot of yield. And I guess that's because there's just a lot of like BTC in total. And every BTC holder has like a totally different risk profile. Some that want to go very low risk, and I think even more are also fine taking a little bit higher risk to generate more yield, just because the nature of Bitcoin holders is so diverse that there are so many different risk profiles. And I think creating a product that is very predictable and transparent, I think this presents a huge opportunity to do arbitrage between the different risk profiles on chain, especially when we also have predictable and transparent yield that's coming from many different sources, like either from staking and restaking or from RWA sources and so on. And I think this is it's a huge opportunity basically to create a product like an automated trade that makes the yield more efficient to the users in a transparent way basically.
Yeah, totally. I mean, to me, the borrowing rates on Aave for WBTC are like, what, 5 bips at best? Look, I mean, it's probably some free money on the table. You bring LBTC, it's been whitelisted on Aave for a long time. It has very efficient LTVs with WBTC and CBBTC with the Aave E mode. You can borrow at 80% haircut, 20% haircut, so 80% LTV. Borrowing at 5 basis points, even if Babylon produces 1% a year. This is an amazing spread to be made, and both WBTC and LBTC are they're basically sort of hard-coded to Bitcoin in terms of the liquidation engine, so there is nothing that can happen to you, to your position, in case there are some liquidity nuances happening on-chain. At the same time, Well, there are probably people out there being concerned about different flavors of wrapped assets, whether there is like Asian audience which is not necessarily big fans of CBBTC, or someone might be concerned about WBTC, the like expensive unwrapping costs, this stuff. All of those risks can be sort of mitigated if you're looping, because if anything happens to the asset that you're borrowing, you don't need to repay anything. So again, like to me, this is probably just the free money on the table.
Yeah, maybe just real quick to touch upon the process of looping, in case not like for the audience right now. Basically, you are instead of staking natively, you are staking with a liquid staking protocol. Then you're using the LST as collateral on a lending borrowing market. Then you're borrowing the underlying again, and then you're staking it with the LST again, right? And you're looping a few times, and based on staking APY versus borrowing APY, you have a delta, and then you can basically arbitrage the delta and really increase a very, very good, basically yield opportunity. You can do that manually, but you can also, do like an automated product around it, and this is basically what this discussion is around. So how could it look like actually, like a looping product with you guys involved?
Yeah, I mean, speaking for Nest, right? Like you'll be able to take NBTC, which is, I guess like not fully liquid because there's a basis trade involved, but like it's or at least the underlying assets, right? Like the collateral, because there's a basis trade involved, so it's that's why it's yield bearing. But you'll be able to take that and you'll be able to like post that as collateral on Solera, which is our primary lending market, and borrow against it and do the whole levered looping process, right? So with that, you can really juice your returns, and because the assets that are like ultimately underlying, like the assets that you're using as collateral as a user are very liquid, right? Like Bitcoin's one of the most liquid assets in crypto, right? So like the way that we look at stuff with Nest is that the asset that has to back your position for most of the vaults has to be like USDC or USDT, because those are the most liquid assets in crypto. They're a cash equivalent, and then like the next thing that you'd be able to use would be Bitcoin, and then the one after that would be Ethereum, because the market has the volume to absorb these. So I guess that's kind of what that would look like. I think levered looping with Nest and Solera is going to look really cool. I mean, I'm going to be putting most of my tokens into Nest, frankly. Like that's what I'm going to be farming when we launch. I'm also really excited to see how we can kind of fit like more of the like Bitcoin like staking and restaking flows into into this financial flow.
Yeah, I think the looping is always about seeing what's the risk, and I think Lombard is basically, or like LBTC is probably like you said, Babylon is a risk-free rate, so to say. So it can probably even use a much higher LTV, can loop it more often, basically. Whereas maybe, and this would maybe also be interesting to dive a little bit into the risks, maybe. But yeah, obviously, NBTC, something like this, like sourcing RWA yields may pose a little bit higher risk. So you'd have to use a little bit lower LTV ratio, and then can loop it maybe not so often, but the idea is to create a product that basically takes the best worlds and creates a product that loops from both sources, and then creates a very sustainable yield source that is fully transparent and sources yield from different sources, basically.
I mean, like as long as the underlying assets are very liquid, and in terms of RWA, as long as the type of trade that they're doing, or the type of strategy that they're doing is like fully delta neutral and very low risk, then the strategy overall is very low risk. Obviously, whenever there is any kind of yield, right? Like there's even if it's a 1% yield, you're getting compensated for some kind of risk that you're taking, right? But like in terms of the risk spectrum, it is very, very, very far down on the risk spectrum for these things, right? So, yeah.
Yeah, combining the best of the two worlds makes a ton of sense. This is what Athena has been doing with ST ETH, right? They were originally making a huge bet on that to collateralize staked Ethereum, earn the staking yield, plus being able to collateralize it on exchanges to execute the funding, the carry trade, effectively earning both the staking yield and the basis funding rate. So both are quite conservative. Both are well proven over time. So, and what is most important, both are scalable to literally billions of dollars, and that's probably the most important thing for Bitcoin strategies.
All right, perfect. Yeah, that's it with the panel. Maybe as some final word, like as I said, like the opportunity for looping is the delta between the borrowing APY and the potential yield. And with Rep BTC, because the borrow APY right now is so low, the delta is quite huge. So it's like a very big untapped market that Loop BTC is going into. If you want to discuss, happy to talk after the panel, or tomorrow we are all going to be around here. Everybody of us can talk about it. So yeah, and that's it for now. Thanks everybody.
Yeah, sorry guys, we actually have time for one more question. If you want to squeeze anything in, our next guy is 5 minutes late. So yeah, if we've got another question that we want to ask.
Damn, I'm panicking here because of the red zero. But yeah. Yeah, maybe then, maybe before we go into questions, one last sentence from everybody, and then we can do a quick Q&A. You have some time about thinking about some good question, and we can do it like that.
Yeah. Okay, maybe I can take one. Actually, one thing I want to ask, maybe this is interesting, because we saw it in the last cycle, I think, there was like Celsius network that was also doing like sourcing RWA yields, but it did more in like a kind of in a hidden box, right? So I think like there was a lot of demand for it, for like sourcing this yield, and I think they had whatever, also like 6-7% yield and so on. But I think creating a product that is really, it's not a hidden box, but it's fully transparent and it's fully on-chain and everything, I think this is such a huge opportunity, and we've seen it from the demand. Like it's very, very clear. It just didn't work out before. Do you see that in the same way? Or
which protocol did you talk about?
I mean, Celsius network.
Sorry?
Celsius network.
Yeah, I think a lot of the issues that have existed with RWAs in the past are definitely due to poor risk management, right? Like which is something that we take very seriously at Plume. It's that, like, I was a VC focused on, like, heavily focused on RWA before I joined Plume. So I did a lot of digging into this space to see like what the primary underlying issues were. And again, it's just poor risk management, right? So I think as long as the risk is properly managed, you're working with the right people, and we have a very diligent, due diligence process for Nest, right? We have a third-party credit rater called Cicada that does like these very deep audits and tells us like how much what types of underlying assets we can allocate to each vault. It's especially on like the private credit front, right? Like that goes back to the originators, right? Like who is building these protocols? How much experience do they have in the actual spheres that they're building in? If somebody is building a private credit protocol, they better have like collectively more than a decade of private credit experience on the team in traditional finance, right? Like you can't just be a full crypto native and expect to build like an RWA private credit protocol. I mean, and it's the same thing with everything. So just know who's managing the money. Make sure that they have very good experience. We're very transparent about that, and we take it very, very seriously. And so yeah, I agree. Like not putting things into a black box is important because the community needs to see that you've done very heavy due diligence so that they can actually put trust in the thing that you're doing.
Yet risk management, you can sort of promise it based on like the expertise of the people in the team, and like you can probably go to the most reliable, well-known institutions to execute the strategy. What is still important is that you sort of trust but verify. Transparency is really important. So that's why, for example, when we launched, we had our on-chain Oracle tracking the reserves of Lombard for the underlying BTC live from day one. And like this type of things is very important. For example, we have this product. It's in Cosmos app chain. It's used for the all the curation and attestation of all the transactions happening within Lombard's consortium for mint redeems of LBTC, accepting underlying Bitcoin, verifying it's where it's supposed to be, executing the staking transactions into the Babylon chain. It's called Lombard Ledger, and it's like it has very boring but such an important role, which is providing very clear, transparent source of truth. And what is going to be really important for operating those off-chain strategies is, okay, risk management is one thing, but then how do we sort of convey all of this information from what is happening off-chain to the on-chain environment and let it make it visible for people on demand. Every hour it should be up to date. Like quarterly audits don't work, half a year or annual audits don't work for sure. So yeah, it should be immediately auditable by anyone, and people can build their own risk procedures, right? I can have me as an investor into this strategy. If I have this transparency in place, I can have my own system which tells me, okay, if there is something wrong with the data I receive on chain, I can pull the funds immediately. And this is very important to also provide this opportunity for risk management for end user as well.
Yeah, I mean, I think most retail end users at least are not going to know how to read that data though. That's my issue with it. Like ultimately, you are trusting somebody else with your money, even if you have 100% of the information. Like, you know, it can be and a lot of the private credit protocols in early crypto like were fully transparent and completely on chain, and they were still, you know, they still suffered from a lack of proper risk management. And so I think that's key. 90% of it, even some of these funds, man, that are trading on chain, you can give them all the data and they're still not going to know how to properly due diligence it and manage risk accordingly. Only like the most sophisticated funds are going to actually know what to do with that data, right? Everybody else just sees yield, big number, put money in, right? So you do, I think it's both. It is both. It's a combination of those things. You need to have the public information on chain so that somebody can call it out. Although I think, as we've seen historically, even when people do call out looming disasters, which, you know, you have tons of people that are you know, like fucking Cassandra from Greek myth, right? Where they're like doomsayers and nobody pays any attention. Like, you know, it happened with like Terra Luna, right? Like there's always public information out there. Sorry, even when there is public information out there, you know, like the most that we can do is, I guess, like hope that people in the ecosystem interpret it properly and like don't use that product. But ultimately, it is about making sure that there is someone that knows what they're doing that's driving the wheel.
All right. Yeah, let's jump into the Q&A. Any questions?
Anyone want to fire a question to these guys?
It could be about anything. I'll tell you what I ate for breakfast this morning.
Oh, there's actually one in the back.
Yep.
Thanks, folks, for the presentation. Quick question, and this is more around the, you know, when we talk about unlocking the next big wave of BTC staking. For these products, what is the sort of like go-to-market plan and sort of like convincing the market to actually use it? I know that we talk about like the yields, and that is an attractive thing in and of itself, but a lot of, you know, potential users are sort of just afraid of the complexity of these kind of products. Like, is there any sort of thought process going towards like how we reduce this away from like staking and RWAs and all that and make it like a product that people feel comfortable just using?
Do you mean like non-crypto native users, or do you mean like explicitly crypto users? Because
more like institutional crypto users.
I mean, I don't know if how afraid of complexity institutional users are, but I will say this, right? Like Nest, at least, like NRWA is a very simple product. It works just like any other rewards token or like Vault product, right? You put money in Vault, you get rewards token goes up in value relative to the amount of yield that you're getting, just like just like Renzo and Lido do for like ETH staking, right? So and then we actually take that one step further. We're working with like neobanks and exchanges for plugging this thing into their applications, so you don't even need to like interact with a blockchain to access these yields. You can literally just click a button, move your money into that vault. It abstracts away the rewards token aspect, so it's still the same thing on the back end, but like as a front end user, I don't have to worry about holding my rewards token and redeeming it or whatever, because I can just like to me it just looks like I put my money in a box and then I get the liquidity out. But like I do think it is important to make sure that you have as solid of a UX as possible. You decrease the complexity as much as possible, and you make it as accessible as possible. Not just for crypto natives, but like as I mentioned, if we want to bring net new capital into crypto, which I think is absolutely critical. We saw with the Trump coin the constraints of liquidity in crypto, right? Like it drained liquidity from everywhere else in the entire space. There's a cap on the amount of liquidity in crypto, and the way to expand that and to get new net new capital on chain is to decrease the complexity and make the UX as simple as possible. So that is something that we're thinking about very heavily. We have a lot of focus on. I can say, for Plume, all of our products are super easy to use.
Yeah, I would also add like the UX part. I think it's very important, making the products accessible for everyone in a very safe way and also transparent way, to be able to verify everything and have like an interface that people can trust as well. So at StakeNotes, we develop a product, StakeNotes Prime, where we basically work directly with institutions to help them to onboard to staking opportunities. And we see a lot of demands for BTC staking, obviously. So this is also an opportunity to directly introduce a product that has marginally higher risk but substantially higher API, and then creating like a full suite that they can use to access the product as well.
Yeah, I would be really surprised if staking rewards don't figure out the UX. So I think we're in safe hands here.
Also, I think adding to the go-to-market side from Lombard perspective, it's also quite interesting because you also have depositors, liquid staking multiple hundreds of millions already in BTC with Lombard LBTC. And now if you're offering them with an opportunity to leverage their position, right, in an automated way, it's also like a you already have people who are committed to your product, and then you can even offer getting more exposure, which can also be a great way to target this from go-to-market perspective.
Should I go ahead?
Do you have another question? Or?
Thanks for sharing. In the past 2 years, the token launchpad attracted more attention from the market. Do you think it's a challenge for the staking track? It seems that the market has become more and more a DJ. So many people trace the high return, but at the same time they get the high risk at the same time. So how to stand this kind of market situation? Because the market has become more and more risk-taking, but the taking track is facing the challenge. What do you think of this situation? Thanks.
Yeah, I have strong opinions on this. I think about this a lot, actually. And this is part of the reason why I'm so bullish on RWAs. Crypto culture has just become, as you said, so incredibly degen. And I think it's a combination of things. And it's kind of recursive, where the first people to enter into crypto had very high risk tolerance because they were the first people to adopt an emerging financial technology with no regulatory oversight, right? So there's an intrinsic level of risk in even just using crypto early on in the adoption curve. So that attracts a very specific group of people. Then these people get insane returns. They get the golden ticket. They basically win the lottery. Then you get another rush of people coming in, seeing these people win the lottery, and they're like, wow, I want to do the same thing. I want to get 1,000x on $100 and then, get 100, you make my year's salary in a day, which is not realistic. And, even in crypto, it's not realistic. It's like buying lottery tickets. And this is kind of created, first there's massive survivorship bias here, right? But it's also just kind of created this environment where like crypto is a full casino, right? Like everything in crypto is either currently, historically, I guess actually not currently, but historically is either purely gambling or powering gambling, right? Like when you think about it, there are revenue generating like pure DeFi protocols like Hyperliquid, awesome protocol, actually revenue generating. But what is it generating revenue from? It's a casino, right? Like that's what Hyperliquid is. It's a digital casino. And staking, providing real value by providing security. But what is it providing security for, right? 99% of the things that it's providing security for are gambling. And crypto needs to mature beyond this. We're kind of stuck here, and I think that Pump Fund honestly did not do the space any favors in the long run. I think that was like incredibly detrimental for the space, which I know is not a hot take, but you know, I think it was a huge step back. So I think you know, on the other side though, people do have high risk tolerances, but not with their Bitcoin. You know, like if we speak with some of these Bitcoin whales and institutions, they don't want to risk their Bitcoin. They want to maintain their delta exposure, and they want to keep their Bitcoin as much as possible. They don't want to risk losing it because that is like it's all the money that they've ever made. So that's why, you know, if you ever talk with Bitcoin LPs who want opportunities for their Bitcoin, the reason why they're willing to take such low yield opportunities, the reason that Boyko generated 4.5% yields, mostly, most other yields were even lower than that, like $3 billion of liquidity that was primarily Bitcoin and Ethereum and staked versions of those assets, is because they're willing to take low yields because of the low risk, the low risk they want. The low risk profile that they have for like how they're allocating their Bitcoin. So it's a little bit different than like Solana users putting money into, or like BNB chain users or whatever putting money into meme coins. It's still very much there, but you know I think that we will start to see that decline a bit as the environment matures. It'll always still be there, but I think it'll start to decline a bit as DeFi matures and as net new people enter the space, and as we open up new avenues for access that aren't just like, you know, your MetaMask wallet. As we deviate from this like pure self-custody and purely peer-to-peer environment and move towards an environment that is even more accessible by allowing people who don't want to use these tools, don't want to use a non-custodial wallet, don't want to take that risk, but still, you know, want to interact with the new opportunities that DeFi creates, be it increased accessibility to RWA opportunities, or you know, or even just exposure to Bitcoin as it becomes a less risky asset, as it becomes less volatile over time, right? So, yeah, I hope that answers your question.
Yeah, I think we've got time for one more quick question from this gentleman here.
Hi, guys. Thank you so much for the really interesting panel. I'm over here. You're looking for. I'm curious, as you guys think about new structured products to create, you probably have your own ideas. You get ideas from colleagues, customers. Maybe a bit of a fun question. Have you had any ideas that were particularly exotic or interesting that maybe you can't do or won't do, but might be fun to hear about?
I had one, but it's definitely not scalable. But there was a funny strategy someone shared on Twitter when Trump Coin launched, which was okay. So you can effectively take your LBTC, deposit it into Pendle, then you split it into principal and yield token, and you keep your principal token, but then you sell your yield token, and with the proceeds, which should, in theory, they should reflect all your future yield from today until maturity. So, for example, 100 days of yield. So you take this 100 days of yield, you sell it, and then you use it to buy some Trump coin. So it's sort of your Bitcoin yield just paid for your meme coin trade, and even if it goes to zero, at maturity you'll still get your 100% of your underlying back in PT tokens. So, well, it's definitely not scalable, but if you want to trade memes, it probably makes sense to not to give up your underlying, but use yield instead.
Yes, I think that's some really great final words for this panel. Maybe loop Trump token at the next staking summit. But yeah, go ahead.
Yeah, I just want to say also, because we were just talking about the casinos and full degen mode. I mean, there's also, like, it's not that we would probably launch it, but you can even do, like, you could theoretically also do something where you have like almost like a Russian roulette. So you have a structured product where like every 10th person gets slashed, and then the slashing yield gets distributed between the others. And then we could create like a real structured casino, basically. I think it could be pretty fun as well. But yeah.
All right.
Next time.
Yeah. Perfect. All right. Don't get wrecked, guys. And yeah, let's call it.
Thanks, guys.
Thank you very much for listening. And yeah, giving it over to Adam.